You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well. Do you remember the good old days where you only needed $1.30 in Canadian dollars to buy a USD? Yeah, I mean, that was the good time at 130, right? Because right now we are at the time of recording at 143. Are we going to get like 150 at one point? This trend is kind of crazy, right? And I'm sure you are asking yourself a lot of questions about the US dollar versus the Canadian dollar. So the idea came from one of my members. So hello, Kevin. Kevin is a DSR member, a longtime follower. I love this guy. I even had a chance to meet him actually this summer. And he's on vacation and he missed the deadline to ask his question for today's Dividend Stocks Rock webinar. So every month, I send an invite to all of my members. They send me questions in advance and I do an Ask Me Anything. It's usually a lot of fun. I answer like 80 to 90 questions. It comes also with a presentation. So like super high level questions and a lot of fun. And yeah, so poor Kevin, he was late just because he was laying on the beach. So I can forgive him. I'm to be honest, I'm a bit jealous because right now it's still around 0 degrees here. And we had snow and we don't have snow anymore. So it kind of sucks for Christmas. So hopefully we're going to have some snow in the next few days. But anyways, I digress. I'm sorry. Back to his question. He was like, all right, so is it a good time to transfer some USD into Canadian dollars? For two reasons, actually. And I'm sure you see that. I see that in my portfolio too. So I always try to maintain a balance between my US investment and my my Canadian investment. And the problem right now is, well, we have two problems. The first one is the US market is doing a lot better than the Canadian one. So everybody's making money this year. We're all happy about it. But the US market over the past few years have been a lot better than the Canadian one. So that leads us to the problem where our investment in US dollars is likely going to be bigger. And the second problem we have is, of course, the crazy ride the USD had versus the Canadian dollar. So just a year ago, we were around 132, 133. So went up by about 10% in a single year. And that was kind of crazy. I mean, back in like 2001, we were around like 120, 125. So just to show how quickly these movement can happen. So now you have bigger USD investments because they perform better, and on top of that, they are worth more. So what to do with that? Well, first things first, now we're talking about really short term. We're talking about like the past 12 months, the US dollar gained about 10% over the Canadian dollar. So all your US investments also were boosted by that same 10%, which is amazing. But that's short term. I mean, that could change in a heartbeat. And we saw that if you pull out the graph, CAD to USD, and you put that over several years, you will notice that it goes up, it goes down like several times. Most of the time, let's be honest, the USD is stronger than the Canadian dollar. So what can you do from there? The first rule that I personally use is I make sure that I maintain my balance between USD and CAD. So the allocation I decided a long time ago that I wanted. Personally, I wanted to have 50% of my investment in US dollars and then 50% in Canadian dollars. I want to invest on the US market for two reasons. The first one is for diversification, because if I'm looking to buy a retailer, well, in Canada, I will buy Canadian Tire. In the US, I could buy Costco or Walmart. That have like no way to compare to Canadian Tire in terms of size, diversification, geographic presence, and so on, right? Also, you can invest in sectors that we don't have many choices in Canada. I mean, the technology sectors in Canada, once you went after Shopify and Constellation Software, there's not much left after that. On the US, you have like dozens of great companies. So it helps you to get better diversification and hopefully like stronger results, because historically the US market outperforms the Canadian one. So hence I decided to go 50-50. That could be another allocation for you guys. It's not the point is not like 50-50 is the rule, is what is your rule. Maybe your rule is like 70% Canadian, 30% US. That's perfectly fine, but it's going to help you as a guideline to trigger action. So if you decided that the right allocation was 70-30 for you, and today you're at 50-50, well, then you have a problem. Well, not a big problem, but you know that you have to sell some of your USD to get back into your balance that you wanted. And it's a lot easier to base your decision on investment rules that you laid out than trying to figure out, is the US dollar is going to continue on this streak in 2025 and reach $1.50 for $1. Maybe, maybe not. But then you are entering into guessing mode. And guessing mode, well, your guess is as good as mine. You're going to start reading, watching, listening, a bunch of experts telling you that the US dollar is going to go this direction, that direction because of this and that. And you know what? They're just playing with their crystal balls, and their crystal balls are as clear as yours. So don't waste time on figuring out where the USD is going to end up in 3 months, in 6 months, in a year. I don't know. You don't know. A million of things could happen, and there you go. So you're better off following the strategy that you have put in place. When I look at my portfolio right now, I'm at like 52% US dollars and 48% Canadian. So there's no rush for me to do anything. I'm pretty much 50-50. It's not enough for me to move, because next month it could go back to 50-50. At one point, if it goes to 55 or 60, then I'm going to start trimming my USDs to get back into Canadian dollar. But we're not there yet, so I don't have to worry about it. But that's the way I would figure this out, because there's no way we will know the future. And of course, as human beings, as investors, we want to be right. So we want to invest the right way and be able to look back in 3 years from now and say, see, I've made that conversion on that day, and that was the perfect day to do it. Well, that could happen. That could not happen. It's just pure luck. So instead, go with your needs and with your strategy. It's a lot better. On the other side, it's also the similar thing. I've been asked, since I run Dividend Stocks Rock since 2013, I've been asked by investors almost every single webinar that I've done since then for the past 11 years, is today the time to invest in the US market? And I'm like, well, today's always the day. It depends on like which kind of strategy you want. So do you want to have exposure to the US or not? If you don't, well, don't. That's good. But there you go. You don't have to ask yourself that question. And if you do, the next question is how much? And if it's 25%, fine. Take 25%, change it, and then start investing. And my argument for that is the worst that could happen over the next 20 years, 30 years, 40 years, because you should be thinking in decades when you invest, not in months, please. Well, if you think in decades, what's the worst that could happen for like the Canadian dollar versus the US dollar? Maybe a change of like what? 20, 25% on the one direction or another. Either you're lucky or you're not lucky. So if it's 25% over like 35 years, is it going to have a material impact on your returns? Not really. Will be exposed to the US market for 35 years will have a material impact on your total return? Well, the odds are good, right? So I'm playing the odds here. And of course, maybe I'm wrong. I mean, it's up to you to decide. I believe, and so far, throughout my 21 years of investing, so far, that has been a good strategy to be exposed to the US market. I've pretty much always been 50-50, and that paid me well. Maybe in the future, it's not going to be the case. I don't know. Like, I just go for diversification, and then I go for quality companies on both sides of the borders, trying to catch the best of what both countries have to offer to me as an investor. And that's pretty much it. I don't look too much on the currency. And for 21 years, it has served me. I don't know if it's going to serve me for another 21 years, but that's the way I look at it. So there you go, Kevin. You got your answer. You can go back to the beach now and relax. I hope that you will have an amazing day. And you, Moose, same thing. We're going to talk again tomorrow. And don't forget that in the meantime, you should be always stay invested. Cheers.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.